All right. Welcome back to another episode of the Real Estate Investing Club. I hope you guys are having a great week. We're actually coming at you from an off day. Usually it's Friday. Today is, I don't even know. Today is Thursday. That is, we've decided to pick up one more day so we can kind of spread them out a little bit more. So if you guys are listening to this on Thursday, I hope you're having a great Thursday. Otherwise, hope you're having a great day, whatever day it is for you. This is going to be an interesting episode. We got Kholt Mulderrig with us from DCA Family Offices. I'm sure you guys have heard about high net worth families investing in real estate as one of their strategies to deploy their capital. And so this is going to be specifically focused on the high net worth families and family offices, and about maximizing the after-tax return. And I apologize in advance. My daughter got me sick, and so I have a little bit of a cough going on. And so I hope I don't do it on the podcast, but if I do, I just have to apologize in advance. But other than that, let's get right into it. Kholt, thanks for hopping on the show.
Yeah, appreciate it, Gabe. Great being here.
Absolutely. I told you before we get on here, we always like to start with stories. We like to hear how people got to where they are. So why don't you take us back to the beginning of your story in real estate and tell us how you got here?
Yeah, absolutely. It's probably not the typical path. So economics undergrad. After that, did actually a couple different venture-backed startups. And during that time, I always had the question of who's on the other side of the veil? Who are the VCs that are behind the curtain that are really driving the operational direction of the company? And so that really piqued my interest in private equity and VC, led me to go get my MBA and then ultimately into investment banking. And during that time, I was really focused on kind of energy, transportation, and infrastructure deals. And with that comes a lot of real estate. And so on behalf of our clients, doing a lot of buy side work, making acquisitions of other companies, but along with that, a significant amount of kind of real estate assets and, partly, redevelopment or kind of core assets and really running the gamut across different kind of asset classes there. And so that really opened up the world of real estate for me. Since then, I've moved over to our family office platform and now lead all kind of real asset strategies. So that would include infrastructure as well as all kind of real estate strategies on behalf of kind of family offices and high net worth individuals.
Nice. So I mentioned right before we get on here, we want to start with basics. So we want to really lay the foundation of your role and what you try to do. So why don't you go into what a family office is and how you are kind of supporting them in deploying their own capital.
Yeah, if you zoom out at a macro level, a family office is really just an ultra high net worth individual and kind of their greater family.
Put numbers on that. At what point do they qualify as a ultra high net worth?
I think if you're a qualified purchaser, I would put you in the in that rank of kind of family office level of wealth, right? So we're talking ability to write a couple $1 million equity checks per individual deal. Got 20 plus million of total investable capital, then you can really start to build that foundation. DCA, we manage around 600 million of equity on behalf of our clients. Obviously, the larger you get, the more scale you have. You can kind of start to build out a fulsome team to go and execute on these more kind of niche strategies.
Nice. So yeah, at its core, it's just rich people. I mean, rich families that usually have their money from some kind of business sale or some other business that's operating, and they're putting it into real estate as an alternative investment to the stock market, to other investment strategies that they would pursue. Correct?
Yeah, that's right. And I think you can look at a lot of different flavors of it, right? It could be a founder that goes through a large liquidity event, they sell their business, they have this new wealth. And there's a diversification strategy around public equities and alternatives. It could be that this is a family owned and operated business, and the business is just generating significant cash flow. And you can buy houses and you can buy cars, but if you really want to start thinking about the next generation, it's about diversifying the overall kind of asset pool. And then I think when we think about kind of family offices, We really think about it as kind of stewardship for the next generation. This is really not, this is not about your money anymore. This is about kind of, hey, what legacy can I build for the next generation, so that this wealth that I've accumulated can continue in perpetuity.
Yeah, makes sense. So let's go into the type of assets that they actually like. When I say asset, I mean I know gold and real estate, they're qualified as assets, but I'm really just talking about real estate. Mobile home parks, self storage facilities. So in terms of the asset type, the type of real estate that they like to invest in, what do you see as the one that's most sought after from family offices?
I think that depends on the family and kind of what their ultimate goals are. In some cases,
or do they care? I guess.
Do they care, right? In some cases, it's purely a diversification play. Like, does it look good in Excel, right? What's the IRR? What's my return on investment? And more of a diversification play to make sure that we have kind of ballast in the portfolio and have some core assets that are just stable versus taking some development risk or some value add risk. So I think that's one flavor. The other flavor is folks that really want to be involved operationally, right? And so that's where you start to see people leaning more towards hospitality. It's really nice to go, sit in your own hotel in the lobby in the bar and say, wow, like I own this. And so that does involve a lot more operational intensity when you start getting into hospitality. But it is, I think, more tangible than just, oh, hey, here's my self-storage facility that's on the side of the road there.
Don't knock self-storage. It's a great asset.
No, yeah, don't get me wrong. The ones that are unsexy are generally the best.
Yeah,
so,
absolutely.
Yeah, we're a large investor into manufactured housing. I think we love the space. It's not necessarily sexy, and it's not generally on the top of people's list when they think about kind of real estate asset classes. But I think it's probably one of the more compelling and recession resilient kind of real estate asset classes out there.
Yeah, absolutely. So taking the perspective of somebody listening, they've gotten to the point where they've deployed all the capital, their own personal capital that they possibly can. They need to start raising money. They need to start doing syndications, come up with a fund, something to get the ball rolling, to start to scale. If they want to start reaching out to high net worth individuals, what is the strategy? What is the what's the way that these individuals like to be reached out to? How do you generally go about that?
Yeah, so it's a great question. We go through a kind of a multi-stage underwriting process, and number one is underwriting kind of the GP or general partner, and really looking at them on a personal level and kind of their strategy and their track record before we even start looking at deals with them. So for folks that are really starting to think about, hey, I want to become a true operator and raise a fund around a particular strategy, I think number one is, okay, what is the strategy and how is it different than what everybody else is doing? Or how are you approaching it in a different way, so that you can really stand out, amongst the other GPs that are constantly pushing deals towards ultra high net worth individuals. On the family office side, we see a huge amount of deal flow, and it's hard. It's hard to stand out. If you're pushing a multifamily deal, I see 10 multifamily deals a day. Right. So how are you going to be different to make sure that, that investor says, oh, that's interesting. So I think number one is, really having your strategy defined and then staying in your lane. Right? Mm-hmm. Like you want to make sure that you're not kind of dabbling in a lot of different asset classes, or a lot of different strategies. People like to bet on subject matter experts, right? They don't want to bet on someone who's never done it before. The next piece is having your track record dialed in. In this day and age, everyone is data driven, right? And so when you're going to pitch a deal, you should be prepared to have your track record available to potential investors to say, hey, this is every single deal I've done. This is how they've performed. And yeah, you might, if you have some losers, that may still be okay. Like, you shouldn't be scared of the fact that you have a loser, as long as you're able to convey what happened, right? I think everyone is forgiving, and they can look and say, yeah, there was things that were outside your control and something went wrong. But
well, and I would say, because I had a storage facility that a while ago that caught fire. From there was a break in, there was a fire, and it was like literally the weekend before we were closing. I already, I'd done the repositioning, and it was under contract, ready to sell. The weekend before, there was a break in, fire. Totally, the whole thing went to shit, and so we had to do this insurance thing, and then we did end up making money, but it wasn't what I had expected because of that incident. And after doing that, I was always like almost ashamed about it, like I somehow, nobody would invest with me in the future. But like you said, I think it's important. Everybody gets hit in the face at one point just because life happens. You can't predict everything that's going to be happening with your deals. Earthquakes happen, hurricanes happen, whatever. You're not going to be able to predict it, and you just need to kind of own whatever it is that happened. Own it and explain it. And so long as you are not the negligent party. You're not the one that made made the gross mistake. If it was legitimately out of your control, or at least mostly out of your control, then people will they will understand that, and they're not going to hold it against you. But the importance is just being honest and owning your story. And so yeah, I just wanted to hop in there because I have my own story about that, and I did kind of go through a period of feeling like I had failed, even though it was predominantly out of my control there.
Yeah, it's your deal, right? You feel personal ownership of it because it is yours, right? So
Yeah.
I think, but that's spot on.
Yeah. So before we got on here, you said that you specifically like mobile home parks. That's something that I'm into. And so let's talk about that. Why do high net worth individuals like to invest in mobile home parks?
A lot of reasons. I think number one, I think if you look at the historical performance of that kind of sub strategy over multiple decades, it's been very, very low volatility. Right? We have a lot of ebbs and flows, and at the end of the day, manufactured housing, there's a need. They're always full, and they just kind of keep going up with inflation over time. You can think of the direct comparison is traditional multifamily. And so I think when we're looking at our multifamily portfolio relative to our manufactured housing portfolio, on the traditional multi side, we have more tenant turns. So every year or two, you got to refresh the interior. If something breaks in the unit, you're going in there and you have to fix that. So there's just more CapEx there. And there's a lot of new supply, regardless of, if you're in a good market, there's going to be new supply. And then if you look at the last couple of years within kind of the multi-space and real estate in general, it's been pretty beat up, and we don't really see a lot of rental growth. And you're kind of fighting to keep occupancy when a new kind of property comes online. And you contrast that to manufactured housing, where it's effectively a ground lease. Your average resident is living there for 7 years. If something breaks in it, it's their house, so it's their responsibility. And your CapEx is really limited to, hey, how do I make sure that the landscaping and the driveways and the kind of the infrastructure are okay? Utilities. And so when you compare that, it's like the risk return kind of profile there. It's you can get to a similar return profile in manufactured housing as you can in traditional multifamily, but with less operational intensity and kind of less risk from our perspective. So I think that's actually just one of the reasons. There's a lot there, but I think that's one of the reasons we like it. The other is just from a tax efficient perspective, right? As a family office, right? These are U.S. based investors, taxable investors, and so being efficient with capital is of paramount importance. And when you have a portfolio that is kind of cash yielding, right, you have taxes due. And so the ability to do a cost segregation on a manufactured housing kind of project and the amount of depreciation that you can actually take as bonus is significant in comparison to traditional multifamily and compared to really the vast majority of other kind of real estate asset classes than maybe car wash. And so for that reason, we really look at it on, hey, what's our after tax return? If I can take 100% bonus depreciation on a portion of that property, and I can use those losses to offset or delay kind of tax liability from elsewhere in the portfolio. It just makes that compounding effect more powerful.
Why do you know why that is? Why is mobile home park? Why are they treated differently in terms of tax depreciation?
Well, I think the big piece of it is because you don't own one, you generally don't own the homes, right? And so what you really own is the land, right, which you can't depreciate, and then the land improvements. And if you're an investor in mobile homes, there's septic systems, there's gas lines. This is all considered by the IRS as kind of short-lived property, right? And so it's less than kind of 20-year life, and therefore it qualifies as bonus depreciation. And so when you compare that to say, an office building, right, which is pretty much just this, concrete shell most of the time, depreciated over 39 years, you don't get the bonus, right? And so it really kind of comes down to just the underlying makeup of the park.
Right. Yeah. That is obvious now that I think about it, because of the life of the actual, from the IRS's perspective, the life of what makes up the property is much shorter for mobile home parks versus something built out of concrete, like you said. So, that makes sense. Do you guys, so we're also into RV parks. We love RV parks, especially now we're really into long-term stay RV parks. We're trying to get as many people that are in our RV parks to stay there month over month. And we're finding it to be a pretty good strategy. They almost act like mobile home parks. They're not as sticky. People can leave a little bit easier, but the return tends to be better. And so is that something you guys also look at, or have long-term, I know it's kind of a newer-ish concept, but have long-term stay RV parks, I don't know, is that something you guys look at?
So we haven't had a concerted effort to go after that as a particular strategy. Within our existing kind of portfolio, we do have RV parks. And I think what we've noticed especially over the last several years, is that people just continue to stay. And so while it's not, we haven't designed it to be a long-term stay, in some cases it, just kind of, that's the natural progression and that happens. And so I think it's definitely an interesting strategy to start kind of pushing that as more of a true thesis.
Yeah, that's that's one of our main marketing strategies for our RV parks is, we look for extended stay. We market like long-term stay, extended stay, and you fill them up. And first of all, RV pads, I don't mean to make this about mobile home parks, RV parks, but RV pads rent generally higher than a mobile home pad would rent for. And it's just a lot easier to bring them in. And so you can do infill a lot quicker. For mobile home parks, for us, what we found, actually bringing the unit in is the fastest way to fill a mobile home park versus getting somebody to bring it in, because it costs $5,000, sometimes $10,000 to get those things in there. They got to pick them up, drive them across the highway, pay for permits. And it's just, it's a ridiculous process. So
the other piece is density, right? That's part of the reason why they're not really building any new mobile home parks, right? Because what's the highest and best use of that amount of land? It's definitely not to build horizontal, right?
Yeah.
It's to build vertical, right? Because in that same spot you can put 400 multifamily units, right? And so, but in an RV park, it's even more dense than a traditional manufactured housing in a park, right? Because you don't necessarily have kind of the yards, or at least not as much yard, right? And you're able to kind of get more units into that acre.
Yeah. Yeah, and municipalities just do not like mobile home parks. We have one out here in Western Washington or Eastern Washington, and it's it's got 30 something sites on it, but there is tons of land that we could expand into, and the city just won't let us expand. They will not let us put additional mobile home parks or mobile home units there, even though it's perfect for it. They just do not like them, and I've seen this across multiple municipalities, is they don't like mobile home parks. And they won't allow you to expand. And so what is out there is, it's what's out there. And so you can't really add additional units, which is pretty disappointing. It goes back to what is highest and best use for the land, which makes sense. But
I think there's a flip side to that. And I think it's one of the reasons we like the space. And you could say this for other kind of investment sectors as well, is that it comes back down to supply and demand, right? To your point, they will not let you build another park. So what, the supply that's out there, that is what it is. And as it, it keeps demand high as a result, as opposed to, being able to bring on new multifamily properties or whatever the particular asset class is. If you have this kind of supply and demand imbalance, there's going to be winners and losers.
Yeah.
And so I think we take that on all investments, right? It's like, hey, what's the supply and demand here? How likely is there going to be another property or another operator who's going to be able to come in and kind of dislocate the equilibrium of the market?
Yeah. Yeah. And which is another reason why mobile home parks, they stay full. If you got the homes in there, they'll stay full, which is another reason why it's such a great asset. We've turned this into a mobile home park RV park podcast, but originally we were talking about family offices. So is there any other? We have run down the clock, and so it's 20 minutes. We got to jump into the quick question round. But before we move on, I did want to ask: is there anything else that you can tell listeners who want to start reaching out to family offices, who want to start raising capital, specifically from high net worth individuals? Any type of advice that you could give them?
I'd say have your story down and have your materials ready. In the family office space in particular, right, we see so much that we don't have time to reply to emails all the time. It's really hard to pick up the phone when someone calls. And we're just always strapped for time. And so I'd say, be ready, because when you get the opportunity, you got to be prepared to answer the questions and have something that they ask for. If they say, hey, let me see your deck, you should make sure you have a deck. If they want to see your track record, make sure you have it ready to go. So I think it just, being prepared to and really pounce on the opportunity when you actually get FaceTime with folks.
All right. With that, I'm pushing us over to the quick question round. Are you ready? All right. Starts with education. It could be any form. It could be a book you've read, a conference you've gone to, a mentorship program you've been a part of. But I need two recommendations. One recommendation for general life wisdom, and then one for real estate.
General life wisdom. I always say The Economist. It takes I don't know, it's not necessarily a real estate book, but I think it's a good macro view. It's a good kind of centrist view of kind of the global economy in general. And for real estate, unfortunately, I don't know if I've ever actually read any real estate books other than like a textbook.
No worries. You ever read Rich Dad Poor Dad? You're the first one. That's
I've not. I'd say we're data driven, so it's we look at CoStar, we look at Green Street reports, stuff that's really what is moving markets today, and really looking at what is the Fed doing, what are interest rates doing, because that's what's really going to shift the trajectory of your investment as opposed to necessarily a book from a few decades ago. I might get blasted for that point.
No, I like it. Yeah. I'm going to say your recommendation is CoStar, so that's fair. All right, next question is for your younger self. Let's go back to the Kholt who was just getting started out so many years ago. Go back to him, look him in the eye, give him one piece of advice moving forward.
Oh, one piece of advice. I would say, follow what you like earlier. Like I think that's my advice. So I went and I did other jobs, went in a roundabout manner to get to where I am. But obviously always had an interest. And I think, I feel like I've probably lost 10 years on trying to find the path as opposed to just going direct to it.
Yeah. Well, it's never lost. It's just your journey. But but a lot of people say that same kind of sentiment. And whenever people say it, we always like to point it back to you, the listener. This falls into the bucket of, I wish I got started sooner. 90% plus of the guests who come on here, of the 600 guests who come on here, say that same thing. So if you haven't gotten started, if you haven't gotten your first deal done yet, this is your kick in the pants. Go out there, get it done. Don't be the guy who says, I wish I got started sooner. It could be anything. Get anything done. Invest into somebody else's deal. Buy yourself a single family, whatever it is. Just go get it done.
Yeah, there's the old saying, right? What's the best time to plant a tree was 20 years ago. And what's the next best time to plant a tree is today.
There you go. That is a good saying. It's funny because I actually just planted trees at my house to block out a view, and I'm every morning I look out there and I'm like, "Come on, guys, grow!" And I know it's gonna take 5-10 years, but All right, next question is about the US. It's a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
Single metro. We actually like, I think, probably the greater kind of Bay Area, actually.
Oh,
Uh,
interesting. Okay.
so I think it's probably a contrarian view, but
Yeah.
you know, the Bay Area is not going away. It's
Yeah.
still the epicenter of tech and innovation, especially when we start thinking about the long term kind of AI boom. And it's been beat up, right? You see a lot of capital going into the southeast. You see a lot of new supply going into the southeast. You also see flat rents, and so I think
And office
we're
space there. Don't you guys have like 30 or 40% vacancy or something like that? Something crazy high?
yeah. I don't know if I'd do office, but I don't know if I'd do office anywhere. So,
Yeah, fair enough.
but residential probably in particular. And there's no news like bad news, and so I think there's some of that gets kind of overhyped in my mind, and so I think we see it as a generally good value play.
Yeah, makes sense. Yeah, you are actually the first person to say San Francisco. That is generally, people, you always hear about people moving away from San Francisco, investing into Texas or something like that. But
Yeah.
but you're right.
I like your area up north too. Vancouver, kind of Washington, and kind of the greater kind of Seattle suburbs. I think are also good markets. It's like it's a stable kind of business environment. You know, generally good kind of tax area.
Yeah, we got Amazon.
You got Amazon.
Yeah, both really good markets. But San Francisco, I mean, it's never gonna. It's such a beautiful city too. It's not going anywhere. All right, next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. You can take this any way you want. You can take it of finding new family offices to invest with you, however you want to answer this question. But what is your favorite way to generate leads and find new deals?
So we take a very interesting approach because we're generally in co-investing with other operators. So I think what we do is define what the thesis is, and then go try to find data to support the thesis in that market, and then we go try to find who are the best people doing that in that particular market, and then we talk to everybody, and so that by the time you've spoken with everybody, you can get a good lay of the land. And through those conversations, you're gonna start to generate kind of the deal flow, right? You'll be in the market, you'll understand it, and you'll be connected with the right people that kind of have access to the right deals.
Yeah, yeah, I like it. So we're gonna say your favorite way is networking. Um, I've said this a few times on the show, but back in the day, I used to do single family and I would always do off market. And I kind of took that into commercial. And I was always like, you're never going to find a good deal unless you find it off market. But I have been, this past like year or two, I've been leaning heavily on brokers because I just didn't realize how good of deals, especially for commercial, are out there through brokers. And it's a great way to find good deals. Networking. It's a lot more fun too because you're just having conversations with people versus talking to sellers all day long. So
Yeah. The other point I'd make on that is, through kind of broker networking is broker, that's an industry as well. They're talking to property owners and trying to get a listing. And so in some cases, if they can go to an owner or a seller kind of knowing that you're in the background wanting to buy that property or a property like that, it makes them more competitive if it's, JLL versus CBRE and they're both trying to get the listing. The guy who shows up and says, hey, you know what? I have a guy that will buy this tomorrow and we don't have to go through, a 3 to 6 month process. We can just get it done, right? The broker can, get their fee, they get the deal, and you don't have to go through a competitive process.
yeah, yeah, absolutely. That's a good point. All right, next question is about lessons learned. Not every deal we get into goes the way we expect it. In fact, many times, if not every time, something will go wrong. And that's when we get to learn a lesson. So what was a deal that you've been a part of that went a little bit sideways? And then what was the lesson you pulled from it?
The lesson on all of these is whatever can go wrong will go wrong. We underwrite, 10, 20 different scenarios on, hey, what if rents do this? What if occupancy does that? What if, the tenant does this? And it always, something always happens, right? It's never going to be exactly kind of the base case you underwrote to. Uh, trying to pull out a specific example, like in manufactured housing space, I don't know, couldn't tell you the number of times where kind of we go in and there's always a septic issue, and you got to dig up the ground, you got to get new septic tanks in, and the lesson on all of this is do your diligence, right? Understand what all the things that could go wrong, and have a contingency, right? Have some capital that's available to address the unknown.
Yeah.
Like don't go in there, skinny, no cash on the balance sheet, and expecting everything to just go as you underwrote.
Yep. Yeah, having cash reserves is so important. Something I've learned more than once. Things are definitely going to break, even if it's like was recently put in. You're talking about septic tanks. We had an issue where it was a new septic tank, and the hoses, or they didn't put the drain line down far enough, and so it was breaking. And so things go wrong all the time. You just got to be ready for it.
Yeah, we had a property out in Montana, and a winter storm came through, and it wasn't even the rain, but just the wind chill beating on the side of the building froze the water lines.
Oh wow!
And so then you had water lines that snapped inside the walls, and it's just like you don't even expect something like that to happen.
All right, but it'll happen, that's for sure. All right, and this is kind of a new question because you've already mentioned AI is so big. I'm a huge proponent of adding AI as many places as you can within your business efficiently. So what is a way that you guys are implementing AI in your business? It could be in underwriting, in lead generation, whatever. Give us some use cases that you found are pretty useful for AI.
Yeah, the biggest one is market research, right? Because I think for us, we're not going to put any proprietary information in there and have it help the machine learn or do anything like that. But it's been a great tool for us to augment kind of really the market research. So something that would take you a really long time to do, it can synthesize that down. And now obviously you got to read it and you got to test it and make sure that it is truly accurate. But just the mass aggregation of data to really get you up to speed on a particular market, I think is been.
I will 100% second that. It used to take me like a full day to do what I felt was good enough research on a new market. And I'm going to say put Perplexity out there as the AI that I like to use. It's a specific type of LLM, but Perplexity is great for that stuff. And you can do what used to take a day of work in, you'll start it and then it'll work for a half hour, and then you'll come back and you'll be able to read the report. And it's just amazing how it works that way.
Yeah.
All right. And this brings us to the last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
So I'm definitely available on LinkedIn. So you can send me a note, and I am horrible at checking it. So what you can expect is that I will get back to you, but it may not be, within an hour.
Fair enough. And I will put that link in the show notes. So if y'all want to reach out to Kholt, all you got to do is click a little more in the description. It's going to pull down that full description, and in there you can find his link. All right, man. That wraps it up. Thank you very much for hopping on the show.
Appreciate the time. Thank you.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review or a comment or whatever you want to do. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.